Aditya Sood of InCred Asset Management is with us. He's our alpha manager of the day. Aditya, good to have you back on the program. I think speaking with you for the first time in the new year. So wishing you the best. In your multi-cap portfolio, Aditya, so many pharma/hospital names. Some we've spoken about, like Indraprastha Medical. But I think you own names like Healthcare Global, etc. as well. We were just having that chat with Deepak Shenoy earlier in the previous segment. And he's a big sort of votary of that. And why not, right? I mean, health is, of course, expenses towards health at a very basic level perhaps is the biggest unknown. And spending towards that is increasing. So almost as a form of health insurance, some of these hospital stocks and the returns that they might generate. Just your thoughts here, on the healthcare space from a hospital point of view, Aditya.
Sure. Very happy New Year to all your viewers and the team at CNBC. I think so broadly, the construct that we are getting into for the broader market is that, the earnings growth is slowing down rapidly. So if you do a top down of, which are the sectors which are going to be fairly resilient in this phase, possibly, pharma is one of them. From a hospital standpoint, I think so one of the things that we like about the sector is that, it is about affordable healthcare globally, from a hospital standpoint. Secondly, it is also about access to healthcare. So when I speak to my relatives or I speak to my friends who are visiting India and who live abroad, the stories that we hear is that, you don't get access to an oncologist for like 45 days in the US possibly. So people want to just fly down and get themselves, checked up. I have spent, 6 years of my life in UK, and we all know, what kind of shambles NHS is in. So essentially, I think so. If you go and see today, hospitals, particularly based out of NCR, there are certain hospitals which are having, as high as 25 to 30% of their revenue coming from medical tourism. I think so. It is a fast evolving theme. Secondly, obviously, it is a well-known fact that India is much more affordable than, all of the other places. Thirdly, I think so there is a change in psyche generally, post-COVID. And when we speak to, hospitals in general, what we are given to understand is that, you look at the sector pre-COVID and post-COVID, what you have seen, for example, in the case of Max, being an example, 8% margins have moved to 30%, sort of EBITDA margins. The same has happened to, Indraprastha, which we hold, margins were stuck in that 10-12% range for like 10 years. And now possibly, margins are trending more towards, 16 to 18%. So that is one element of, margin improvement. Secondly, I think so there is also a lever of marginal occupancy improvement, which is happening now. And we have, more, sort of capital allocation getting better for certain names in the sense that people don't want to get into that capex mode. So there are a lot of acquisition which is happening in the sector. For example, we have seen acquisition by Yatharth. We have seen, JP hospitals getting acquired. And we are also seeing a lot of private equity deals, in this space. So that leads us to believe that, there is a lot of margin potential and ROC rating in the sector, which we are going to witness going forward.
Aditya, what else? What are the new ideas for wealth creation? Where is it that you see opportunity now? In the last 1 or 2 months, have you made any new, have you spotted any new ideas?
So our focus is very clear. I think so broadly, we are in middle of a turmoil, that turmoil needs to, needs to be understood from a perspective of, what is happening in global bond markets, what we are seeing in the currency market also, in the sense that the euro dollar is, more or less closer to parity. Now, this all will create an opportunity because what we have seen is that, there are a lot of companies which have corrected very, very sharply, and a lot of large cap names are down by, 20-30%. So there are only two kind of stocks that we like at this juncture. We like companies wherein the sector is going through a headwind, at this juncture. But that headwind has resulted into a gap of price to value perception. And obviously MFI is one such sector, which is facing that headwind. It is most of the MFI stocks have corrected from 50% to 70%. Now our framework says that, possibly we'll buy the best managed MFI company, which in our view is Credit Access Grameen today. But what we are resorting to is that, we won't buy the full weight, because we do understand that, possibly there could be 1 or 2 quarters of pain which can come through. But we are buying these stocks from a 18 to 24 month perspective. Possibly we believe that, from a 2 to 3 year perspective, these stocks can double. So that is a huge focus area for us. Second focus area is to buy, companies wherein we have already seen a correction of 30-40% quality stocks in the portfolio, and we would like to add some weights. For example, Tejas is a case in point wherein 1550 stock price has corrected very sharply to 1140. Nothing has changed in the fundamentals. In fact, the fundamentals are now getting strengthened. So our view is that we will stick to the core, and we will buy companies wherein we see opportunity. Or else another opportunity that we are seeing is in special situations. So we have recently added a company known as Religare Enterprises. Obviously, there is an impending open offer, which is there, that this is a corporate change event. And obviously, it is closely linked to the way Care Health is, sort of trading in the unlisted market. We believe that the discount is very, very stark. Basically, Care Health is trading at a 16 to 18,000 crore valuation. I think so. It is easily one of the better managed health insurance plays in the country after possibly, ICICI Lombard. I would rate, Care Health very, very highly, given the fact that they have grown the gross underwritten premium at 32% CAGR for last 5 years. They are very, the combined ratio is close to, 101.5. That leads me to believe it is part owned by Kedara Capital. That leads me to believe that there has to be a value unlocking event over a period of time. And obviously, if you do sum of parts of Religare, you will see that there is a broking business, and there is a lot of optionality in the sense that if the management control is with the Dabur family, obviously, you can expect the NBFC over a period of time to get levered over. So we find special opportunities to be a very, very interesting case in point at this juncture.
Okay, all right. Hi, Aditya. Good afternoon. Good to see you. Ben, you gave us many stocks actually in 2024, and a lot of them did well. And as you're saying, you're backing yourself still on Tejas Networks. I was going to ask you when it's time to get off the bus, but you believe that it's time to just add on that one. So clearly you have a fair bit of conviction. But let's talk about a couple of larger names then. HDFC Bank case in point. We briefly discussed that, I think, somewhere in the middle of 2024. What's the view on the stock? The last quarter's operational performance wasn't very, very great. But there were pockets that actually they're correcting themselves. Also, valuation-wise, in comparison to what it trades at, it's not very, very expensive. Similar is the case with the Bajaj Finance twins, FinServ as well as Finance. They have started 2025 in style. Your view on particularly these two names, Finance, FinServ as HDFC?
So, essentially, our view on some of these great companies, and, we have focused on a framework wherein we say that, possibly all the great companies can make zero return for 3-5 years. It is very normal in the stock market, and there are 2 ways to make money in a stock. Put it very simply, we don't see any further room of price to book, deterioration in possibly a Bajaj or a HDFC Bank today. I would say that, I would back these companies that, possibly if I'm buying HDFC Bank at 2 to 2.2 time price to book, and if I do the sum of the parts, and obviously a lot of value gets also derived from the subsidiaries that they have, especially in the case of Bajaj Finserv as well. So we own Bajaj Finserv, we own HDFC Bank as well. So our view is that there is very limited room to lose money. Now, where can you go wrong? Possibly you can go wrong in terms of the earnings growth that gets delivered. But our extension of the thesis also is that great companies are great because they can bounce back, and when the environment is tough, possibly, we are more focused towards whether they are gaining market share at this juncture. So I think so. Each of these names have got, different challenges. But our view is that, whether they have lost market share in a down cycle, possibly they have not lost market share in a down cycle. again, on financials, one thing is very, very clear, that it is the ability to manage NPAs across the cycle well, rather than chasing, fast growth. So, more often than not, we keep on hearing that, HDFC possibly as a case in point would have, as I'm given to understand, has, stopped lending too much to the solar companies. So this is a business wherein you need to have the ability to go fast and slow. And this is a business wherein you need to focus on medium term and not short term. So that is how I would like to put it across. We see significant value accretion over a period of time. These are large cap names, so your expectation of return has to be moderated here. I think so 15 to 20% CAGR, possibly over a period of time wherein 5-year return has been zero, should be the right kind of expectation from these names.
Thank you very much, Aditya, for joining in, and wish you and everyone at InCred a very happy new year. A quick word on IT and Tata Elxsi, where there was some news. Tata Elxsi, remember, has been one of the big